This is your LMAX Exchange technical update for Monday, October 23rd, 2017. Eurodollar. So the euro has been showing signs of the possible formation of a major head and shoulders top on the daily chart, and it's going to take a break though back below the neckline, which comes in at 116.60, right by that August low, to trigger the formation, opening the door for a significant decline all the way down into the 112s. That head and shoulders top, if triggered, would target a move down towards 112.30. At the same time, while the market holds above this neckline support, the uptrend remains intact, and this is just viewed as a bullish consolidation. What's also interesting about the market though right now is that the neckline here would coincide with the 100-day moving average, and this is just after several days back we saw a smaller head and shoulders top trigger that had coincided with the 50-day moving average. And so we'll see if that happens over the coming sessions. If the market closes down below 116.60, and this shaded area here is also a strong support in the same area by the Ichimoku cloud support at the bottom of the cloud, break below there suggests a shift in the trend, and that's just over the neckline. So a lot of support coming in here. A breakdown below 116.60 and a close below there, a daily close, would trigger the formation that could open the move all the way back down towards 112.30. If we don't break below that level, it would suggest that this is just a bullish consolidation ahead of a resumption of this intense uptrend in 2017. So the key levels above and below right now are 116.60 below and what could be a right shoulder around the 119 area, and so we're defining 119.10, that left shoulder from back in August, as the key level resistance above. If it breaks above there, then we could be headed for a bullish continuation. Sterling dollar. So cable has been chopping around more or less over the past several sessions. The market has been recently under pressure off the 2017 high up around 136.60, but the pullback was to be expected after quite a nice move to the top side. Overall, this is a market that is recovering in 2017 and showing signs of the formation of a major base after breaking out above 127.75 earlier this year, and after showing signs now of a major bottom off that 2016 plus 30-year low in the 118s. And so if we do see additional setbacks over the coming sessions below the recent support that was seen back in early October at 130.27, setback should be limited to that 127.75 area in favor of an eventual push back to the top side, as this market shows this longer term bottom up through some key resistance right now at 133.38 and towards a retest and break of the 2017 high at 136.60 about, which would expose a move towards 140. Dollar yen. So dollar yen has been exceptionally bid over the past several sessions. The market had potentially shown signs of stalling out into a recent rally into the 113s, but given the trend that we've seen, the range that we've seen in this market for much of this year, it wasn't surprising to see the push higher, so that the market could adhere to this range, and that range resistance, the top of the range, comes in around the 114.50 area, and so there's risk now for the market to push up towards that range high in the 114.50 area before it considers the possibility of rolling back over in adherence to the range and breaking back to the downside. So over the coming sessions, additional upside risk in dollar yen towards 114.50. Key support for this market now comes in at 111.65, that low that we saw on the 16th of October. Euro Swiss has pushed up to another 2017 high, just squeaking out a 2017 high beyond that previous high that was seen back in September. But ultimately here the trajectory and the trend is favoring the top side following a bullish breakout in 2017, with the market seen pushing back up towards what was some monumental, critical previous support going back to January of 2015 and before that at 120 when we had that floor. So that's going to be the next key resistance level above. Any setbacks here should be supported, and only a break back below 112.60 at this point would compromise the current outlook. Aussie dollar. So Aussie dollar has been showing signs of topping out in 2017 after putting in a plus 2-year high at 81.26, and so rallies that we see right now are expected to be capped in favor of lower tops and additional downside. Right now, a break back below the recent support at 77.34 from going back to early October on the 6th would confirm a lower top and open the next downside extension into the 75 area. Dollar CAD. So dollar CAD, as we've been highlighting, has been showing signs of the onset of a correction, which we believe should still see additional upside over the coming days. The initial key resistance is at 127.80. That's the August peak, and that level is expected to be tested as this market again continues to show signs of the formation of this correction after a significant decline in 2017. All the way down towards 120. So the focus now is 127.80 above, and now any setback should be very well supported by recent lows in the 124 area. Kiwi dollar. So the New Zealand dollar showing signs of topping out in 2017 after putting in a plus 2-year high just back in the month of July at 75.58, has been under intense pressure and now gravitating towards a retest of the 2017 low, which comes in at 68.18. At this point, any rally should be very well capped ahead of 72, that previous lower top, and while only a close back above that level would compromise the bearish outlook for Kiwi dollar. SPX 500, well, the story here has not changed. The market continues to push up to fresh record highs. What has changed, though, on the daily chart is that the market is once again pushing up into some severe overbought technical territory on the daily. We're already seeing these readings on the weekly and monthly time frames, but on the daily, with the market pushing up here, it would suggest that additional upside could soon be limited for at least a consolidation period, if not a sizable correction that takes the market back down towards the 2500 area. We would, however, need to see a break now at a minimum back below that low that was seen in the previous week at 25.44 about to suggest that the market is, at least on a very short-term basis, looking for some form of a reversal. And we would say that given how this market is traded, we would need to see a break and close, a daily close below 25.44 to strengthen that possibility that the market is looking a little bit exhausted. Gold. So gold has overall been very well supported despite some intense setbacks in recent months. The general broader direction here has been higher, and so setbacks should continue to be supported here at this point, ideally ahead of 1250, in favor of the next major upside extension back beyond the 2017 high at 1357 and through the 2016 peak at 1375 further up.